Hey, good morning, everyone. Marty Missouri here. It's Tuesday, the 16th of January, 2024, with a quick market update. Clients, this will come linked to an email for tomorrow morning's message. Nothing new, no big revelations in terms of the equity market technicals. They don't look really good right here. But I wanted to just start this morning with the message that I shared on the written blog this morning. And the main message was one of breadth. If you haven't read that and you're a subscriber, please go ahead and read this particular post. I think the quote, I won't go through that here this morning on the video, is really, really important to think about things and how we should be thinking about our long-term portfolios anyway. After that quote, I said, speaking of behavior, although the quote really speaks to behavior of an individual as an investor and how to be successful. Then I segued to behavior in the aggregate sense. And last week I touched on sentiment, which looks concerning right here because it's too bullish. And I said here that while the November-December rally in stocks was characterized by a very nice and encouraging broadening of breadth, i.e. not just those 7 stocks that incredibly fueled the market other than those last 2 months, alas, this year has kicked off with a really ugly breadth look. So here's the S&P just year to date. What are we, 2 weeks into it? So we won't put too much weight on this, although it's something to consider. The green line is the equal weight index. You can see it's rolled over, notably negative already, while the S&P is just slightly in the positive. The advanced decline line rolling over, so more decliners than advancers, and I'm going to show you today's read in a second. Number of stocks in the S&P trading above their 50-day moving average. I've shown you the long-term chart. This one's a pretty good timing indicator. You can see it's rolling over, 200-day rolling over, going the opposite direction, so breadth is waning, and the one that is just really ominous looking is this one. It's the NASDAQ Composite Index. Here's just a 5-year chart, but you can take this one back a long ways. Notice before COVID, it was rolling over 40% decline, I think, in the comp. Last year, rolling over, AD line hard, 30-some% peak to trough decline, gotten it all back. About as bad a bearish divergence as you'll ever find, right back here at these highs. Doesn't mean it's going to play out with another 30 or 40% decline in 2024. It just means that the risk per this indicator is too high for comfort that could be an event during the course of this year. So here's the look today. So this is the Bloomberg function IMAP, which basically gives you sector by sector look. So here's the S&P off 0.04%, so call it flat. 67% of the stocks are actually negative on the day. Only 3 sectors are up: tech, discretionary, and communication services. The rest are all down. Energy is down a bunch. Industrials is down a bunch. Financials are down a bunch. Materials and so forth. In terms of number of securities and so on, as you'll see here, 370 of the S&P 500 stocks are down. 2 to 1, a little worse than 2 to 1 in the NASDAQ are down, and the NASDAQ is actually up 0.35%. So folks, this is just anything but a healthy looking market. Drawn parallels to this look in 1999. I'm not going to tell you that we should bet the farm, that we're going to have a early 2000s kind of market, which was resoundingly ugly. I'm just saying, with the abundance of indicators here and on the macro side, it is prudent to not load up the boat like you might if stocks were considerably cheaper and the overall backdrop was considerably more favorable. Doesn't mean you shouldn't own equities. It just means that there should be some hedging, some cash, perhaps some defensiveness via, gold and that sort of thing. And I'm just speaking our own book right here, to be honest with you. Okay, so real quick now. It's the S&P 500 daily chart. That's an ascending triangle, but you've got just massive bearish divergences on the daily. The weekly looks very precarious, as I showed you a week or so ago. On the 60-minute chart, just to look at even the short-term setup for this week, it was not real bullish on a short-term basis, and that appeared to play out at the beginning of the day. And this is why you've got essentially the same pattern as you do on the daily. You can see the big gap down, but as I just showed you, the S&P is trying to fight that back. We'll see how it does through the course of the day. But you've got, yeah, and again, this is just short-term stuff. I do know that there are some short-term traders who happen to watch these videos. And then on the QQQ, the NASDAQ 100 index, same look back here, right near the highs from July. Massive bearish divergences. Might as well look at the 60-minute chart there as well. Yeah, same look. Breaking out sideways from the wedge. We'll see how this plays out. But yeah, you wouldn't be very encouraged right here. A swing trader would probably find a range in there to go very actively short and long as things bounce around. Russell 2000, I think I skipped this one this last time. I mentioned the Russell VIX being very elevated. It's at 22 today. The S&P VIX is actually pushing 14. It was actually north of 14 a little earlier. But anybody trading the Russell on a short-term basis needs to be concerned. As I've shown you here, this could be a bear flag pattern. If that's the case, we're going to go down almost right onto this pretty good looking support potentially at around 1882 on the Russell. 10-year yields. I said the other day, if you're a bull in stocks, you don't want this to be a bull flag pattern because stocks have been going the opposite of yields. They broke out a little bit here, maybe today. They were up quite a bit earlier. We'll see. Dollar up is a headwind for stocks. It was big early in the mornings. Yeah, I think the stocks were down noticeably more than they are right now. But the dollar's still up 68 basis points. And again, that doesn't quite look like your bull flag like it might in yields. But it's a consolidation off of some momentum that looks like it may want to go higher. So strong economic news in the U.S. would do an upside number on yields and on the dollar. So interesting dynamics, folks. This is going to be quite the year as we move into it for a variety of reasons. And we will pay very close attention and manage according to conditions as we go. Thank you as always for watching and listening. Talk to you again soon. Bye-bye.